Welcome back to the channel, traders. Today we're diving deep into an exclusive strategy that can give you an edge in the Asian session. This model focuses on precise liquidity grabs and market structure shifts. It's simple, effective, and perfect for those who loves working with clear rules. Let's jump right into the Asian session model. So here are some most important checks that you have to follow. Step 1. Start by marking out 8 p.m. to 10 p.m. New York time on your chart. This time window sets the stage for our model. Step 2. Identify your nearest liquidity levels on the 15 minutes time frame. These are crucial as they represent the points where price is most likely to gravitate toward before making a move. Step 3. Once the price takes out liquidity, immediately switch your chart to the 1-minute time frame. This is where we start fine-tuning our entries. Step 4. Wait for a market structure shift with displacement. This displacement should leave behind either a fair value gap, FVG, or an order block. Step 5. Enter your trade at either the FVG or order block. Both are high probability areas to enter after the market structure has shifted. Step 6. Set your stop loss to cover the swing point of the market structure shift. This gives your trade enough breathing room while protecting your capital. Step 7. Finally, place your take profit at the next opposing liquidity level or target the negative 2.5 standard deviation level. Now that we have covered all the steps, let's look at a few real-world examples to see how the Asian session model plays out in live market conditions. Here, we have the 15-minute chart of gold, Monday, September 16th, 2024. We've marked our time window from 8 p.m. to 10 p.m. according to New York local time. Additionally, we have marked the nearby 15-minute liquidity levels and observe how the price reacts. We'll break down each step, from liquidity grabs to the market structure shift, so you can see exactly how to apply this strategy in your own trading. As you can see, the market has rated the sell-side liquidity. Our target in this case will be the nearby buy-side liquidity, which I have already marked. Notice how the market, after taking out the sell stops, then shifts its focus to the buy-side liquidity. You can also see my execution here. Now let's switch to a lower time frame, and I'll show exactly how this strategy works and when we should enter a trade. Here is the 1-minute chart. As we mentioned before, we take our entry on the 1-minute time frame. You can see that as soon as the market targets the sell-side liquidity, we switch to the lower time frame. At this point, the market undergoes a CSD, change in state of delivery, and creates a high probability order block. Why is this a high probability order block? As we discussed in the previous video, a strong down close candle that takes out the sell stops, followed by the market closing above it, forms a high probability order block. As soon as the market retests this area, we place our trade, set our stop loss at the swing low, and aim for the opposing liquidity level. As you can see, the market structure has also shifted, allowing you to take an entry based on the IFVG, inversion fair value gap. You can use any entry model you're comfortable with and have a strong grasp on. However, if you'd like, I can make a video specifically covering advanced entry models. Here, you can see how smoothly the market has hit the target, and on the lower time frame, you can also observe my execution. So, let's move on to another example. Here is the 15-minute chart of gold from September 17th, 2024. We have marked out our time window and also identified the nearby liquidity levels. As you can observe, the price has run through our 15-minute buy-side liquidity, and our next target is the nearby sell-side liquidity. You can see how the market manipulates downwards to grab the sell-side liquidity. Now, let's shift to a lower time frame to find our entries. Here's the 1-minute chart. After taking out the buy stops, the market showed a downside displacement and created a fair value gap, FVG, along with a rejection block. We will wait for the market to retrace back to our rejection block, and then we'll enter a short position. Notice how the market respects the rejection block and continues moving toward our sell-side target. You can also see how the 2.5 standard deviation aligns with our target. So here we add one last example. This is the Australian dollar versus US dollar on a 15-minute chart. We mark our time window and also highlight the nearby liquidity pools. The price raids the sell stops within our time window, and now our attention should focus on these relatively equal highs, which are our next liquidity pools on the 15-minute chart. As you can see, the market manipulates towards the buy side to reach our target. Now we shift to the 1-minute chart to observe how we execute. Here, after taking the sell stops, the market structure has shifted to the buy side, and we enter in the FVG, fair value gap, but we got stopped out. No problem, as we know nothing is 100% in the market, so we'll look for the next opportunity if it's within our time window. Once again, you can see a market structure shift after grabbing the sell side liquidity, and we enter in the FVG. For those familiar with ICT, this is the 2022 model, and here you can see how the market reaches our target, which is the next opposing liquidity level on the 15-minute chart. And that's the complete breakdown of the Asian session model. This is a powerful yet straightforward strategy for capitalizing on the liquidity movements in the Asian session. As you can see, the Asian session model is all about precision and timing. By following these steps and paying attention to liquidity and structure, we can catch high probability moves with confidence. Remember, practice is key, so go to your charts, backtest, and refine this to match your style. If you found this video helpful, make sure to like, subscribe, and share with fellow traders. So I'll see you in the next video. Good luck, traders.